Toronto. And our guest for this Google Hangout is Ariel. Uh, Ariel has been he's a prolific angel investor. In fact, he's one of the most connected investors in the world. Uh, One of the things that my company does is rate investors based upon their strength of network and how much capital they deploy. And Ariel, out of over 22,000 investors in California, is ranked number 16. So he is by far the most connected and influential investor that we ever had as a guest for Startup Growing Toronto. So we're grateful for him participating with us. Just to give you a sense, he's participated in SlideShare. He was chairman of the board of Stumble Upon, which is a Canadian company originally out of Calgary. He was on the board of Odeo, which is a precursor to Twitter, among many other things. So let's get a startup. Brian, welcome to Ariel. Okay, so we're going to try to mimic the intimacy of the chat that we had in February when we were actually face-to-face sitting in a chair with about 40 people. I think that's going to work.
I think so. Let's give it a try.
All right. So first of all, I didn't really delve into sort of the international nature of your background and sort of how you came to arrive in the U.S. And so maybe a little bit about sort of the Stanford MIT experience to kick us off, and then talk a little bit about that story of how you gave yourself a year to be successful with a startup.
Sure. So I'm originally from Venezuela. I left Venezuela after high school to do my undergrad at MIT. I realized there that I was not particularly good at math and computer science, which is what I was studying. But I took a class at the business school, and that went really well. So I decided that maybe that was a better route to go. So after that, I went to Stanford to do my MBA. And when I was there, my plan was to do a startup. And I was pretty fortunate. I was there between 92 and 94. So the web came along, and I decided that was a good place to go do a startup. And I then had the idea to do an analytics company. It was the first web analytics company. And but there I was a Venezuelan with a student visa. And as some of you might know, when you are a student in the US, you do have the benefit of something called practical training, and which is 1 year during which you can work any work you want. But then at the end of the year, that's that. And it turned out that that was pretty helpful for me, because what I was able to do was give myself that year and said, I'm going to give this startup a try, and I'm not going to second guess myself, and I'm not going to worry about anything other than the startup. And I knew, and I thought at least, that if things didn't work out, I would go get a job. And fortunately, I mean, actually, the first few months were pretty tough, because back in '94, the internet was not particularly popular. So most people in Silicon Valley thought I was crazy and I should go work in interactive TV or AOL. But after 6+ months, things started to take off. And then before the year was up, I was funded. I was able to sponsor, get myself an H-1 visa, and take it from there. So yeah, I don't know, that's a short version of how, coming from outside the U.S., outside Silicon Valley, I was able to get started, if you will, in the ecosystem.
What was the first startup that you took out, and maybe a little bit about the story behind that?
Sorry, the story behind iPro, my first startup?
Yeah.
Yeah, so basically, again, these were the days when there were no commercial, no advertising on the internet. We would go to a website called NCSA What's New, and every day we could see the 3 or 4 new websites that were launched on the internet that day, or on the web that day, I should say. So very early days. But brainstorming with some friends, we thought, people are going to use the internet and the web, I should say, for marketing, and somebody's going to have to help them and do like the Nielsen of the web. Seemed like a good idea, and so that was what I started. And early on, the plan was analytics, help people understand who was going to the website, spoke with some of the early companies on the web, they didn't even know how many pages they were showing or how many files. So we scaled back to help them understand that. And the first few customers turned out to be ad supported. So the early internet players like Yahoo and CNET and so on. So we became more of an auditor. Basically, they wanted to sell advertising. They needed a third party to give credible numbers to potential advertisers. So that's what they asked us to do. We follow what our customers were telling us. Eventually partnered with Nielsen Media, became Nielsen iPro. And yeah, in 95, 96, we were auditing the vast majority of the ad-supported sites. Eventually, we sold the company, and I moved on to do other things. But yeah, it's a really, really fun ride, actually.
So when you say you sold the company, is that the company that you went through the IPO with?
So I'm having a hard time hearing you. I don't know if you're coming. I don't know if you can separate your microphone from. Oh, much better.
Okay, I don't know where exactly the mic is, but anyhow, I am the mic. So when you say you sold iPro, was that the IPO the first IPO that you were involved in?
No, not really. We sold iPro to a combination of to another private company called Engage, and eventually Engage did go public. But by that time, I was not involved anymore. The first company, maybe just to complete the story, after I left iPro, I started working with lots of entrepreneurs that were working with other startups, and I joined a few boards. One of the boards I joined was a company called Cana Software, was one of the early CRM plays back, we're talking 96, 97. And back then, there was no CRM focused on the internet. They were focused on phone systems. So we were one of the first companies that would help companies do support via email. And so that company I joined as kind of like a founding board member and stayed there through the IPO. We took that company public in 2000. So that was my first hands-on IPO, if you will, at least as a board member. Yeah, iPro, I was not involved with the company anymore by the time the combined company went public.
So how did that IPO go? What was the valuation at
Cana was ridiculous. It was one of the top IPOs of 2000. I think at the peak, the company valuation was $11 billion, which was really, really, really crazy. But yeah, those were the crazy years of 2000.
Okay, so hands up everybody who's been involved in an $11 billion IPO. Oh, hey, there's one. Okay, and just in case you're wondering, there's nobody over here. So the story. I mean, there are many stories, and feel free to kind of interject with any one that you want. But the story that really stuck out in my mind from our chat in February was the story of sort of the transition between audio to Twitter, and the kind of the experience that they were going through in terms of taking out Twitter and really not knowing what they had and not really understanding. I mean the themes of Startup Grind are inspire, educate, and connect. So I think this first part here is about your story. I think this Twitter story is really inspiring. By the way, what we're going to do in terms of your questions tonight is to get you to just come up here and ask the question. Okay, so if you have questions. How many people have a question? Put up your hand. Okay, I want to see 25 hands go up next time I ask. Anyhow, so we'll get you to come up and ask your question. But so Ariel, could you just sort of recap that story and the story of audio and the transition to Twitter and the process that they were going through, trying to decide whether to sell Twitter or what they're going to do?
Yeah, I mean, the first thing I should say, and one of the things that I often tell entrepreneurs is don't believe anything you read in the blogs and you hear or in the books or you hear from a speaker like me. So there's so many different stories, so many different angles, and I've been fortunate enough to have been involved with several high-profile companies, and I know for a fact that the history is written after the fact, and you don't want to say, oh, we got really lucky, or you just say, oh, we were really strategic. So at least my recollection of audio, I was working, I thought podcasting was really great. I reached out to Evan Williams when he was doing audio, and we were working together on it. And the long story short is it was not going well. And it was not going well. And at the same time, Evan, who was the founder CEO, was about to get married. He was not having a good time. So he came to the board and said, I don't want to do this anymore. So we're like, well, what do we do? And at that time, we said, we should try to sell this company, because you have a company without traction, with a founder CEO who doesn't want to move forward. Should we sell it? So everybody agreed, including Evan. Yeah, let's go try to sell this thing. Now, a little bit before then, because podcasting and the audio business wasn't doing very well, Evan had asked the team to come up with other ideas, and Twitter had come up. Jack had thought of that, and it was one of the most promising ideas. So there was a small team of a couple of people working on Twitter. But again, it was, even with Twitter initially, it was unclear how big that was going to be. So we went and we tried to sell the company. And I was the one on the board that was asked to go and reach out to an investment bank. It had to be a tiny boutique investment bank, because we didn't think we could get, at the very best, we thought we were going to get $10 million for the whole thing if we were lucky, and not too many investors.
And that was on a $20 million investment, right?
No, Audio had raised $5 million.
Oh, okay.
Yeah. So the initial amount of money that Audio had raised was 5, and then already three was still in the bank. So, so we found an investment bank, and they start working. And to make a long story short, we try to support them and help them sell the company. And we said, you can sell it with or without Twitter. And I remember suggesting to them, why don't you go talk to MySpace, which at the time was still big, but was starting to lose ground to Facebook. And I thought, maybe this Twitter thing, they can use this to go against Facebook. Nobody would buy Audio, even including Twitter, for nothing, free. Nobody would take it. I mean, there was like no takers at any price. And after that, we like, okay, what are we gonna do with this thing? We couldn't keep. I mean, the status quo wasn't good. So that we remember, we had a board meeting. It's like, do we shut this thing down? Do we scale it back? And that's when Evan said, you know what? I'm not having fun, and I'm not enjoying this audio thing and this approach, but I decided that I want to do an incubator. And so what I'm going to do is I'm going to buy everyone out, and I'm going to start an incubator called Obvious. And this Twitter project, which I think, is promising, it's going to be the first project inside the incubator. We're going to put Jack, who was the person who had the idea, to run it. And that's what he did. He took, bought everyone back. And, as they say, the rest is history. It did take a few months after that. I would say 3 to 6 months, I don't remember, after that. Twitter started to get more traction. And even initially, it was just one of the projects inside Obvious. And only after a while, and it became clear that, oh my God, this is huge, they decided, okay, forget all this Obvious thing. Let's just focus on Twitter. But in the early days, it was not at all obvious. And I will say that's the same with most of the other projects that I've seen. And most overnight successes take a long time. And there's a lot of... in most cases, it's not this big vision from the beginning, but it's just the evolution of an initial idea.
You have a kind of a contrarian view. I mean, I think that piece of advice that you sort of offered to begin with is that anything that you read, don't believe. What are the other kind of pillars of your advice to any entrepreneur?
I mean, a few things I would say is, one is, you cannot predict if you're going to succeed or you're not going to succeed. It's just impossible. But you can decide to go work in a space that you like with people you enjoy. So what I tend to encourage entrepreneurs to do is make sure you're having a good time, you're learning, you're working with good people, and then it's a win-win, because if the company goes great, terrific, and if the company doesn't do well, at least you're in a better place. You can move on, do the next thing. And I get really concerned when when I feel that an entrepreneur is just doing something because they think it's going to be a big business, they're going to make a lot of money, because it's just so risky. I mean, the odds are it's not going to work. And then what you end up with if you were working with people you didn't like, or if in a space that you don't particularly enjoy. So, I mean, that would be one point. And I try to do the same thing in my angel investing, which hasn't always been good in the sense that I will only work with an entrepreneur that I really like. I will only work with someone that I want to have over for dinner at my house, because you never know, and at least I want to work with great people. And what I say is not necessarily the best strategies. More than once I've met entrepreneurs and I've known, or I've felt, oh, this is going to be huge. This is going to do so well, but I just don't want to work with this person. And so I pass. And then you go back and you go, oh my God, what have I done? But yeah, life's too short, I guess. There are a few other things that have come up over time. One is that I think speed is overrated. People are always running, trying to go fast. And the reality is it's more important to be going in the right direction. And until you know the right direction, then the most important thing is not to move fast, but to try to determine what that right direction is. And I've never seen a startup that fails because they move too slowly. I mean, by the way, and I'm not suggesting they're incompetent. Yeah, you want to be efficient, you want to do things well, but more often than not, it's a startup that gets it right and does it well that win, or the one that gets lucky, as opposed to the one that just moves super fast and and not focusing on anything else. I mean, those are a couple of thoughts there that I like to share. I mean, I have a few other I can go back to. Oh, there's there a question in the back?
Yeah. Come up here and introduce yourself quickly.
Hi there, my name is Sammy. I just had a quick question about you being in San Francisco. How important is that in terms of ideas? Because in Toronto we have a community, but it's not that big. So it's hard to meet other people who are in the startup scene and doing things. So how important was that for you to be in San Francisco, and in terms of how all this happened to you?
I mean, it's a tough one. Obviously, San Francisco is a very special. I mean, I'd say San Francisco and the rest of Silicon Valley is a very special place where you have the benefit of having so many other people around doing interesting things. So it's definitely very valuable to be here. I don't think that it's a must for everybody. I think it depends on what you're doing. It depends on the stage. So I think for many companies, they might be better off somewhere else. Some companies might be better off moving here, but not right away. Like in the case of, say, StumbleUpon that I work with, they already had, I want to say, definitely hundreds of thousands of users and some pretty good traction when they moved to San Francisco. So it's also a very personal thing. You see people, you have to do what is right for you. And some people have built great companies outside of the Valley, obviously, and other people feel that if they're not here, they're missing out. They need that network. So it's, I think you can go, sorry that I don't know if I might not be helping you so much, but I think you can really go either way. It's a very personal thing. Now, what you have to be careful is you don't want to be, for example, to give an example, if you want to be like an angel investor focused on Silicon Valley, you better be here. You can't try to do that remotely. In a similar way that if I wanted to be focused on Canada, I would have to spend some time there. So you have to make sure there's an alignment between what you're trying to do, and it's also not necessarily black and white. I've seen some people who try to spend some time here, and that could work. But it could be the wrong thing for sure. If you, for example, don't have, hiring people and finding people here is very, very, very tough. So if you have a startup that already has a core team and you can move to the Bay Area without needing to build a team right away, but you to, if you will, complement the team, that could work. On the other hand, I've seen single entrepreneurs who come here without a good network, just trying to build a team from scratch, and that's a really, really tough one. They might be better off in other places.
So just a follow-up question on that. In terms of the financing, so you make it sound very simple that you went to this investment bank and talked about money. How simple is it? You just go and pitch and then you get the money, or it's very simple? Because I saw your profile. You invested in 20 companies and
He's actually invested in over 60, but
60.
If you would like a check right now, it's that easy.
Yeah, they make it sound super easy. You do a pitch and then you get $5 million.
No.
Sorry, what did I make sound? What did I? Because when I was talking about the investment bank, that was to sell a company, and it was even hard to hire them. I had to pay them money for them to help me sell the company. So I'm not sure what was it that sounded.
Yeah, the question was, you hear about these companies raising 5 million, 10 million, 50 million. It sounds so simple that anybody can go in and get some money based on an idea. So.
No, I mean, I think what I would say is you hear about the success stories. You don't hear for every success story there are 100 failures. So it's not easy. It's definitely not easy.
So raising the money for you, how big of an issue was that? If you knew you had a good idea, would you?
You mean when I did my startups?
When you did your startups, or when you raised money?
So just to be clear, so I've done some startups for which I raised money. And when I invest my own money. So I've never raised money like for a fund or anything like that. But for my first startup, it was very hard. It's in 1994, and nobody was investing in the internet. So that was pretty hard. Now, what does happen is once you start building a track record. So what got me my first round, which is I think still true to this day, a very valuable thing. I managed to get a bunch of people to help me for equity because I had no money. So to give you an example, the founders of Yahoo, Jerry Yang and David Filo, they were working on my first prototype for me. I had people from a bunch of other places all helping me. And the investor that I got, what he told me after the fact was, I had no clue what you were doing. I didn't understand it, but I saw everybody who was willing to help you for equity. And I thought, okay, he must be onto something. So those kind of things help. And then as you start, you have a success story, you do well, you build relationships, then people want to back you. It does get easier over time. But first time around, it's not easy.
So let's say if I have a startup, I have a core team here in Toronto, and then I go to San Francisco to raise some money. What would be some of the biggest obstacles that I would face? Even though, let's say I have a good idea, I have a core team in Toronto, and then I go to San Francisco, how hard would it be for me to raise money? And how would I go about it?
That's a very, very tough general question.
Yeah. Because that's what I'm looking to do. I'm looking to move to San Francisco in the next few months.
It's hard to give you a generic answer without knowing the specifics. I think that I'll just try to give you two quick examples. In the case of StumbleUpon. So the guys connected with me.
Sorry, just let me frame that for a second. So how many people are familiar with StumbleUpon? Okay. So this is a guy who went to the University of Calgary, created kind of a bookmarking type of search, refer it. I don't know what the official title of it is. And then Ariel was involved in helping them move to Silicon Valley. They eventually sold for $85 million to eBay, and then the founder bought it back, and he's also the co-founder of Uber. Okay, go ahead.
So, that's one extreme where it's interesting. They first reached out to a VC who I will not name, who they didn't think much of it, but he knew me, so he said, "Hey, Ariel, this guy's, I'm not so sure, but you like early stage consumer stuff, you're interested in meeting them," and I said yes. So I meet them, hit it off, like what they were doing. So then I went and helped them raise money. So they had me, who had a track record helping them. They had hundreds of thousands of users, and then whenever the potential investors saw the product worked beautifully. They had a solid business. They were not making money yet, but the business model was clear down the road. So they had a lot going on for them. We raised the money in 4 days, so that was very easy. And then the team was ready to move, and they had ready technical people. On the other extreme, if you have a team, I've seen teams where yeah, they want to move, but they're waiting for the money, so they're not. So they're half here, half there. That doesn't help. The product has no traction. It's unclear what the business might be. It's a crowded space. They don't have a local person helping them. Yeah, it might be uphill. So there's everything in between. Without knowing the specifics, it's hard. But I mean, my one piece of advice would be try to build a network, talk with people that can learn your specifics, and based on your specifics, hopefully give you advice.
Go ahead, Grant.
Hey, my name is Grant, and my startup is Parkbench. I think it's really cool that you were a startup entrepreneur and now you're an investor. So I hope you could definitely delve more into why you made that leap and what do you think makes a good entrepreneur turned investor. My question is, as an entrepreneur, what do you think are the best ways people should be valuing themselves when they talk to investors? And as an investor, what do you think are the ways that you value startups? Is it the same or are they different?
What do you mean the way the entrepreneur should value himself?
Like, how you value your startup? How, like, the valuation methods
the valuation
should be using? The entrepreneur going to the investor, what kind of valuation should they be coming to the investor with? And is that the same way as that you as an investor go and evaluate startups?
Yeah. Well, so first a caveat, which is, so I focus, as many people here in Silicon, I'm only primarily focused in Silicon Valley, and we're focused on startups that we think can be huge. So I don't worry too much about the valuation, because I want to get involved with the super successful teams and startups, and I'm not about to, do I need to get a XYZ IRR, etc. So the first thing I would say, and I think it's the same from the entrepreneur standpoint, the valuation should be one of the last things you worry about. Many entrepreneurs are too concerned about the valuation. I mean, you don't want it to be ridiculous, but the priority should be you want to get the best possible investors to help you build a really big pie, and not focus early on, I want to protect and have as much of the pie as possible. The way it works out, there's some rule of thumb, numbers for, well, if it's a startup and it's really early and it has a few people and they're raising a seed between $500,000 and $1 million, usually you might value it at X between 3 to 5 million, and if it's a Series A and you're raising 2 to 3, you might value it at 7 to 12. So it sort of like works out. What I would say is that as an entrepreneur, don't go in. I think the best thing you can do is go to an investor saying, you tell me, especially if it's a large investor. They're going to tell you, here, we're willing to invest, and this is the terms that work for us. And if you only have one offer, and it's a good investor, then maybe you should take it. If you have many offers, then it becomes a market, it's supply and demand, and it can go up. The exception to that would be if you're doing one of those runs where you're just getting a few angels or friends and family and a little bit of money here and there, then you do have to go with a proposal. And then you should find out what the what the market rate is, if you will. And it depends also a lot on how much you're raising. You don't want to give too little of a company or too much of the company. So I would say a rule of thumb is, if it's a seed round, I think ballpark, you might want to give somewhere between 10 and 15% of the company. So what does that mean? That if you're raising $500,000, then maybe the valuation could be $3 to $5 million. If you're trying to raise $1 million, then the valuation needs to be a little bit higher. And it works the other way around. If you cannot justify a higher valuation, then you might need to raise less money. That's just very, very rough, but there's no science to it. And I think the smartest, most sophisticated investors and entrepreneurs don't overthink it and don't worry as much about it.
What percentage, I'm just going to sort of riff off of this for a second. What percentage of deals now are being done on a convertible note basis in your circles, or on the SAFE model that Y Combinator?
Yeah, I would say the majority, I would say probably I see, 70, 75% of the deals I see are either a convertible or a SAFE, which it's more or less the same, with a cap, and then maybe roughly a third might be priced. Some people really care about it. I don't understand it. I don't care. I don't think it's that different one way or another. And I'm not optimizing for the failure cases or the edge cases. In most cases, whether it's priced at 6 million or it's a cap at 6 million, I don't particularly care one way or the other.
Right, but you do think there should be a cap.
There absolutely needs to be a cap. The cap, and it's interesting because the entrepreneurs some entrepreneurs understand it, but not all, which is the cap makes sure interests are aligned.
Right.
If I had a situation, great company, the company ended up doing really well, but this is way back when I got involved, there was no cap. I told them I think this is a really bad idea, but they held back. They really wouldn't do a cap, and I really wanted to work with them, so I said, fine, whatever. And then they're trying to do their Series A, and they're trying to get my help. And they say, Ariel, can you call this VC and convince him evaluation should be higher? I said, no, I can't do that. I mean, why am I going to work against myself? You're asking me to raise my own price. I mean, I have to be candid with you. And no, you don't want me talking to the VC because my interest is for the price to be low. Had there been a cap, yes, I want this valuation to be super high because my price is fixed. I mean, you want the other thing that, if you think about it from a fairness standpoint, I mean, the investors should pay based on the value of the company or the company's worth when they put their money in, not at some future time after which hopefully you as a great investor help them get to that point. So yeah,
actually, so that actually there's a fine point that you made there that I haven't seen anywhere else, that the cap actually works as a motivator. It works in favor of the startup, in that if you have the cap, your seed investors are going to be going out there and working their networks to get a maximum valuation for your next round. But if you don't have a cap, that motivation is actually the opposite.
Yeah, exactly.
That's an interesting fine point. So in our last chat, by the way, we had Dominic Belanger, who is the VP of Strategic Investments for BDC Capital. Now, Ventures. And BDC runs a convertible note program in Canada, and they've made over 60 seed investments in startups across the country. They're helping to set a standard across the country on this convertible note. As Ariel just mentioned, about 75% of deals in Silicon Valley are being done on a convertible note basis. So we're trying to sort of educate investors on this. So one of the things that BDC gave me permission to do was to share their convertible note documents with Ariel, and so that he could provide some feedback on that. So what are a couple of the things that you noted in the convertible note structure, both in terms of how does it conform to what you typically see, but also how we might sort of talk to our friends here and get something that is sort of more consistent with the Silicon Valley standard?
Yeah, I mean, what I've seen in that case, and also I've done some investments in Latin America and so on, and you compare those to Silicon Valley, and what you see is in Silicon Valley, particularly the most sophisticated, experienced investors, keep things super simple, super clean. Here's the money, give me a bit of the company, or agree to give me some percentage in the future, and we're done. And then the kind of stuff you see with, I think, the less experienced investors are things like conditionals that say, well, I agree to give you this money, and I'm going to give you more, but only if you meet this milestone or that milestone. And those things, usually are bad ideas and are lose-lose propositions. Sometimes they're called tranches, where it's sort of like, well, if things go well, then the investor gets to put more money. If things go bad, they don't. So what does that mean for the entrepreneur? It means that if things go well, I sold too cheap. If things go bad, when I really need the money, I don't have it. So it's like the worst kind of thing. Now, if that's the only way you get money, then I guess you do what, at the end of the day, if you need the money, you need the money, but you want to avoid that. And again, from the standpoint of the investor, the smartest investors know they want to be entrepreneur friendly, they want to be supportive, they don't want to put the entrepreneurs in a position where they end up, for example, being so diluted. I've seen abroad many investors who have carve-backs that let them get more equity if things don't go as planned. So then you end up with demotivated entrepreneurs. I think yeah, the terms, the simpler they are and the more aligned they are for the success of the entrepreneurs. I think investors understand here in the Valley that you want to help the entrepreneur be successful, and then you ride along. We're just riding along, helping the entrepreneurs.
Great.
Yeah.
Hi, I'm Jean Leggett, and I am starting a startup with my husband. He's an industry vet, and my question to you is, I think we're a little bit idealist, and we're in the seed stage right now. So we're raising money from friends and family. It's been pretty cool. For angels and for venture capitalists, how important is the end result of an IPO? I think we would like to stay in a profit-sharing model, but would that scare an angel or a venture, a VC away?
You mean, I'm not sure what you mean profit sharing. You mean you don't want any kind of exit, like either selling or an IPO, or you just want to pay dividends or something like that?
Dividends. We want to keep it small because we've been through 2 IPOs with Zynga and Electronic Arts, and well, you know.
For most investors, I would say most, if not all, institutional investors, meaning either a VC or a micro VC or quasi angels that have small funds, etc. An exit of some kind is a must because that's how the economics work. It just doesn't work if the numbers just don't work out to get dividends, if you will. So I would say that model would eliminate 90+% of potential investors are not going to be interested in that. I think for obviously when you go to more of like what you're doing, friends and family, there's a notch above where it might be an angel investor that's related to the industry or who knows you. Then obviously they're a little more flexible. But for the vast majority of the more professional investors, if you will, yeah, the way we look at it is, at least from the financial angle, is we expect an exit at some point, and that's what it also becomes challenging, particularly here in Silicon Valley, where, for example, you're competing for talent, so the equity becomes very important. But if the equity is not going to be associated with a big outcome, but it's some kind of like profit sharing, that is definitely more challenging. I mean, it's not to say that, hey, there's some nonprofits that can recruit great people. So I'm not saying that it's a showstopper, but yeah, definitely complicated, particularly here for sure. By the way, it's not. I mean, I have one of my very best companies that I'm on the board of, a company called Freedom Financial. We're talking a company that has 700 employees and revenues in excess of $100 million. It's an LLC because it's a very profitable company that pays dividends, and I'm very happy with that. But again, I didn't go in there, and usually the way I think about my angel investing is not that I go in because I have some money that I want to put to work. I don't have a fund. Usually, and somebody asked me before, why did I switch to angel investing from entrepreneurship, is I found that I really enjoy helping entrepreneurs and that I was actually better at it than doing my own thing. So I decided, you know what, this is more fun and I'm better at it, so let me do this. Now, if I'm helping an entrepreneur, I should share in the upside. So what's the easiest way of sharing the upside? Well, let me buy some of the equity. So for me, the buying the equity comes after the fact that I want to help the entrepreneur, as opposed to, I would say, probably most investors first decide they want to put money to work, and they say, well, I want to be a good investor and help you. I'm kind of like the other way around. So I would say that in your case, if I were to hear what you're doing and love what you're doing, I would say, great. I don't care that it's that is targeted as a profit sharing. But I'm the exception, I would say. The majority of the investors would care.
Thank you. I appreciate that.
So you are an investor in AngelList.
Yeah.
And you spent some time with Best of Angel, kind of developing a platform to assist companies sort of bridging themselves into Silicon Valley, correct?
Yeah.
A couple of backgrounders. And right now, you've got over 60 angel investments, and about 1 in 10 is a deal that's outside of Silicon Valley.
Yeah, something like that.
So what would it take to turn that to 9 out of 10 or 5 out of 10. I mean, there's so much conversation these days about Silicon Valley moving to the cloud. I mean, as the Toronto community, we like to believe that, you can invest here or in Kitchener-Waterloo or in Ottawa and, still have great companies and great talent to invest in. So what are the kinds of trends? Do you think that money is moving more easily outside of Silicon Valley? And then, what are the kinds of things that would interest you beyond the Valley?
Yeah, I mean, one of the reasons why I have been spending some time working with things like Best of Angel and companies outside is that I found that here in the Valley, I mean, when I started doing my angel investing and helping entrepreneurs, this is over 10 years ago, there were not that many people who were doing what I was doing. So part of what made me feel great is I would help these entrepreneurs, and I felt that if I hadn't helped them, then no one else would have helped them. I mean, they might still have done well, but without somebody's help. Now there's so many people here in Silicon Valley helping entrepreneurs that the best entrepreneurs get help one way or another. But that's not the case in most other places. So part of what I want to do, and I should emphasize, this is not because from a financial standpoint where I think I would still be better off in the Valley, but from an impact and fun standpoint, I think I can do more outside the Valley. What it would take, what I've struggled with, is so far I found difficult to add value remotely with most entrepreneurs. It's hard. It does take a certain type of entrepreneur who's particularly good working remotely, keeping you posted via email, chat, Skype, and so on. I don't particularly like to be on planes. I don't particularly like to speak on the phone for too long. This kind of event is great, and it's a kind of technology, if you will, or organization that shows that, yeah, you can do a lot of stuff remotely. So what it would take would be a combination of the right entrepreneurs and also the right systems, which I haven't quite found yet, but I think will evolve, that would allow me to really help remotely without having to spend too much time on the phone or too much time on a plane.
Go ahead, Kevin.
Hi, my name's Kevin. If someone's doing a pitch to you to ask you for money, what are the top 3 things that you want to hear from them to get a yes?
Well, I mean, I should start by saying that
my name is Michael.
Statistically speaking, 9 of the people who give me a great pitch are going to hear a no. That's unfortunately just because you can only, and that's the same with any active investor. You just, particularly here in the Valley, we see way more great, not just pitches, great pitches from the ones that we have the capability to do, whether it's from our time standpoint or from a money standpoint. What I would say is that it boils down to, you need to get me really excited. And what I have found is that what gets me excited is different on a deal-by-deal basis. So it's not about checking boxes. It's not about, oh, whoever can do this, X, Y, and Z has a good chance. It's like, whoever can get me excited. Now, maybe you get me excited because you're so awesome. I'm like, I totally want to work with this guy. Maybe you get me excited because the product just blows me away. Maybe you get me excited because of the opportunity or the impact that the product's going to have, or something else. But I think that in general, entrepreneurs should be careful to try to do, how do I check all the boxes within investors? Because for most investors, it's less about that. I've seen so many investors who will tell one or another entrepreneur, oh, you're too early, you're too late, you're too small, you're too big, you're too this, you're too that. And then I see them do deals that are much worse in that dimension, but somehow got them excited. So find what is sort of like the, what really, if you're going to go pitch an investor, I mean, one of the things I encourage entrepreneurs to do is, I think the most important factor in a successful pitch is who you are pitching to. Don't go to the usual suspects, but go find out who are the investors who, from their blog, from their tweets, from their other investments, from their interviews, they're saying things that indicate they're going to be a good fit for you. And then go, get them excited. So I think that's what I would say about that.
Perfect. Thank you.
So we're getting down to the last 10 minutes or so. we made Ariel wait a little while they cleared the soccer pitch, or football pitch. And so, if you came here with a question that's on your mind, please, come up and take this opportunity. So, tell us a little bit about how a deal. Now, so when I say he's like 16th out of 22,000 with Steven's score, I mean this means that Ariel is seeing or having an opportunity to view most of the best deal flow. There are very few people in the world that have better deal flow than him. So, tell us a little bit about how deals come to you through. I mean, some of the other people that are in this, in these kinds of circles, Ron Conway, Mark Andreessen, Naval Ravikant, who's the founder of Angel List. So there's, it's a pretty prestigious group. So tell us a little bit of how a deal might come to you through your networks. I mean, you don't have to name names, or you can if you want. Give us a few examples. But.
Sure. What I have found is that the number one source of deals for me are the entrepreneurs that I've turned down, and the reason being that I've turned down lots of entrepreneurs because I've met with lots of entrepreneurs. But what I try to do is I always try to be helpful. So in the meeting itself, or as a follow-up, or making introductions, I try to be helpful to the entrepreneur, and many of them appreciate that. So what ends up happening is that maybe that entrepreneur does another project, or maybe that entrepreneur has a friend that's doing a project, and they tell him, hey, when I was going through this process, Ariel was helpful, so you should talk to him. So it turns out that I get a lot through that. Obviously, the entrepreneurs that I've worked with have very extensive networks. So it's either when they're doing, I would say at least a third of my investments are working with people that I already worked with in the past. And you see a lot of that. Somebody else was asking about, is fundraising easy? Well, it's definitely easier for those who are more of like serial entrepreneurs and have a track record. So it's either them, or they are angels themselves now, or they are someone who they know. Like I just did an investment in a company of 2 former employees of an entrepreneur that I know, and he's like, I'm backing them, they're great, meet them. And then of course you mentioned people like Ron or Naval, etc. Whenever, I think what we try to do is that if we think there's another investor who would be particularly value added to a company, then we reach out to them, and so they might reach out to me and say, hey, Ariel, we're looking at this deal. They know that I do few, compared to someone like Ron or Naval, I do relatively few deals, so I don't get like bombarded with deals. It's more just the handful that they think would be a good fit, and I really like it that way because I don't want to spend all my time looking at deals.
And what about syndicates? Are you involved in any syndicates, like AngelList syndicates?
I am not. I think AngelList syndicates are great, but for the right people, and not for me. The kind of thing, again, I am not trying to put money to work. I'm trying to help entrepreneurs. So, and part of the value that I bring could be helping them find other investors, etc. So for me to be in a syndicate, it's just not really what I'm about. I think for other people, it's great.
Leo.
Hi, how are you doing? My name is Leo. I have 2 questions. My first question is, what's the ideal number of a board member staff should have? And my second question would be, how much percentage of the company entrepreneurs should give up to each of the board members?
So the first question is how many board members to have, and the second question, what I didn't understand.
What kind of comp did the board members get?
Okay. So first thing I would say is I think boards can be super valuable if you have the right people. So I'm glad to hear that you're thinking about it. It changes with stages. The typical thing might be that at the very early stage, a board might be the CEO, and then maybe one person who's from the investor group and one person from more of an outside board member. You should think about the board as just a group of people who are going to be really helpful. So I'm not sure the number is as important. You don't want too many, you don't want too few, So I would say in addition to the founder, ideally 2, because otherwise it's just too few. So somewhere between 3 and 5 people for most companies. Larger companies could have bigger boards, but then it starts to get a little hard to manage. I wouldn't worry about then being like an odd number as opposed to an even number, because there are rarely any votes. I mean, the boards are not about, the good boards at least, are not about voting for stuff, are just about helping the management team and the CEOs. Regarding compensation, it depends. Obviously, if you're representing the investors, you don't get any additional compensation. If you are an outside board member, then you usually get compensated with either just equity or equity and cash. It depends on the company. Most earlier stage companies just do equity, and depending on the stage of the company, the profile of the board member, etc., it can be, I would say, anywhere between, and assuming it's kind of early, somewhere between half a point, half a percentage point vesting over 2 to 4 years, and as high as, I've seen it as high as 5 points when you get like a superstar that's going to be super helpful, super active. It also depends, is this a board member who's going to just devote a few hours a month, or if there's someone like I've done in the past where I devote a day a week to the company for a year. So it depends, but you try to find a number that works for everybody and focus on getting the right person.
So if it was a day a week for a year, what kind of comp?
So in that case, again, it depends on the stage of the company, but it's then you're talking more like 3 to 5%. Again, it depends on. I mean, in my case, I'm less worried about do I get 3% or do I get 2%, and I'm worried about am I helping build, kind of software link exchange or StumbleUpon. Now, it's not going to be 0.1%. That much is the case. It also depends on, are you doing it pre-financing so that you're going to get diluted and so on.
Okay, so did I warn you about the Startup Grind speed round?
No.
No. Okay. So this is they're doing this across a few chapters now. So I'm going to ask you 10 quick questions, and you're going to give us 10 rapid-fire answers that are brilliant. Are you ready?
Sorry, I can't hear you. I think the connection is about to break down.
Okay. So here we go. Startup Grind speed round with Ariel Pollard. What item do you own that you would never sell?
My espresso machine.
Good. What is your most unusual skill?
Making espresso.
What's more important, strength, speed, or stamina?
Stamina.
What historical figure do you admire the most?
Historical figure. That's a tough one. The flying spaghetti monster. Does that qualify?
That's it. That's it. What's the best compliment you can receive?
The best compliment that I can receive, that I'm a nice person.
Have you guys ever read his blog, by the way? So you should check it out. It's basically a conversation with his kids. So you should, like lessons that he gives to his sons. What's the best compliment you give to others?
That I enjoy spending time with them.
Who do you think does a good job?
Who do I think does a good job? Sorry, I don't understand that question.
Who do you think does a good job?
Like a specific person or a specific,
Yeah.
or like a, who does a good job? I I think Mark Gainey does a good job. He's the CEO of Strava.
Okay. What is your favorite season? Kiteboarding season.
Yeah, the windy season. Thank you.
When was the last time you tried something new?
Yesterday.
What was that?
Sorry, I can't say that in public.
Right on. Okay. Yeah, we'll take this offline. If you could have the attribute of any animal, which animal would you choose? Or what attribute? I don't know. I didn't write these, by the way.
Oh, I would like to be a bird and fly.
Right on. Okay, any other quick questions, anyone? Okay, go ahead.
Hi, Ariel. Thanks so much for talking to us. I'm Blair Leggett, and I'm just, when you say the important quality of stamina, I'm just wondering what helped you through those early days when you were a student and, you know, you had that year in which to sort of make it. And, you know, when we're doing our 100 hours a week trying to keep our products moving, the momentum moving, I just would love to know what worked for you and what was particularly poignant in that way. Thank you.
Yeah, I mean, so a combination of things. One is, again, not second guessing yourself. So having, say, hey, I'm going to do this for a while really helps. Really being excited and believing about something. I mean, I think that the one thing you want to be careful about is it's great to not second guess yourself, and it's great to keep going and keep going. But you don't want to keep going if you stop believing. So as long as you feel there's something there, then that definitely helped me feeling like I was onto something. The people around, I mean, I think that's having people who support you both professionally and personally. So in my personal life, like my wife at the time, or in a business sense, surrounding yourself with people who are cheering you and supporting you, that's super important. Yeah, and then I think finding a way of having a good time. I mean, I'll give you an analogy. Most people seem to hate doing remodeling works, but I really enjoyed remodeling my house because, I don't know, I went in knowing that it was going to be over budget and that was going to be over time, but I just found a way of, I don't know, I had a good time doing it. So I think startups are the same way. You try to be in a mindset where you try to enjoy the. I mean, you're never going to enjoy like some of the really bad things, like, I don't know, having to let somebody go that's not working out. Those things you're not going to enjoy. But there's plenty of stuff that you can find the good in, if you will.
Okay. When we did our first Startup Grind event in Toronto, we did a Skype conversation with Eric Mijikowski from Pebble. It was about 10 days or a week after he had just raised $10 million on Kickstarter. And this is just the second time that we've tried that. So what do you guys think? This work? Yeah. So thanks, Ariel. And thanks, Pivotal Labs, for what is a considerably better setup than we had when we were sort of basically setting a camera on top of a milk crate with Eric, and he was sitting on the edge of his bed in his hotel room or in his flat in Silicon Valley. So thanks, Ariel, for that. And I just wanted to close off by thanking Gwen, who does our camera work, thanking Joel, who's the global CTO. Put your hand up, Joel, for Startup Grind, and Ahmed, who is our sort of #1 volunteer. Eric's doing the social media over here. Jackie, who's at the back there, who is keeping it real. Emma's already left. So thank you very much. And just a reminder of who we've got coming up. Jordan Levy from SoftBank Capital out of New York City on September 25th. Jim Scheinman from Maven Ventures. Jim was a founding employee in Friendster and in Bebo, and stayed with Bebo right through their something like $850 million exit. So that's October 8th. Alan Lau from Wattpad on November 27th. And we haven't announced this yet, but Steve Green, who is Google's kind of head techie in Canada. He heads up the Waterloo office. and they've been responsible for Google Plus development and this kind of. So he's going to be here on on October 23rd, and Pivotal is going to be our host for all of those events through the rest of the year. So we've got a good lineup. Thank you for coming, Ariel. Thanks again.
Pleasure. Thank you.
And we'll circle back with you about Kitchener-Waterloo for November.
Sounds good.
Okay, thanks so much. Take care.
All right. Bye-bye.
Right, bye.